Measuring the order flow will improve your trading drastically. If you understand how to use ICT concepts, then you are already 50% ahead of most traders. So in today's video, I will be showing you how to use that to your advantage to reach the next level. Which PD arrays do we use to measure the order flow? The first and the most important one, in my opinion, will be highs and lows. The second one will be fair value gaps. Then the third will be order blocks or mitigation blocks. Highs and lows. In order to understand where price is likely to go, you need to know where the next draw on liquidity is. So whenever you're measuring the PD arrays, you're going to want to use the high and then eventually the low. Where would that external low be here? It would be as far as you can see where the next low would be, or right here. You have to use external levels whenever you're measuring highs and lows to understand where the next draw on liquidity will be. You can use internal levels, but if you know where the external is, price is likely to reach there with institutional order flow. Therefore, the highs and lows are the most important PD array to understand order flow to the next level. They can be used inversed as well. External resistance liquidity is the most important. Not just any high and low can be a draw on liquidity. Majority of the time, price seeks external resistance liquidity to complete the move it was intended from the start. Internal range liquidity can be a short-term draw which is inside a range. If you are not following the higher time frame order flow, it would be ideal to partial add in internal resistance liquidity run high or low. External ranges are very important because price either seeks that to complete the move. See that it seeked it, completed the move, and then it rallied back up. That's what external ranges are for. Internal ranges, you can run right through them, use them as inverse, and then continue to the external level. That is how you view and measure the order flow with highs and lows. Fair value gaps. Fair value gaps are used to have price redelivered to that inefficiency and fill in orders that the algorithm has left behind. As little pockets that the algorithm will seek, as ICT stated before in his mentorships. Using fair value gaps to measure order flow is important to understand that there are multiple types of fair value gaps and they all have their own purpose. There will be a buy side imbalance, sell side imbalance, there will be inverse balanced price ranges, there will be implied fair value gaps, there will be so many fair value gaps that you can use to help you measure the order flow. Inverse fair value gaps tell you which side of the market you truly want to go to. So I would use a change in the state of delivery with fair value gaps, especially inverse ones, to tell me if I am on the right side of the marketplace. Internal resistance liquidity. Fair value gaps are used as internal resistance liquidity since majority of the time they are inside of a range from the external highs and lows. I don't usually take profit at these areas. I anticipate price to run through them and reach my external level. So suppose here you have, let's go back a little bit. So here, let's go here. So suppose here you have a sell side imbalance right here. You ran through this low, but you never closed. You had a sell side imbalance there. And then eventually what? You see price ran right through it. It was used as an inversion PD array and eventually came back and it retapped into it and then it rallied. That is the strongest price delivery here to tell you that the order flow has switched. It went up. It created a balanced price range here. This would be your balanced price range. When a balanced price range is whenever the market runs both sides and it overlaps. That is when a balanced price range is created. A fair value gap is fair value. You can see the inverse is not directly that. It's usually a balanced price range leaves both sides unfilled. That's what makes it a balanced price range. With inverse, it usually fills it up on one side, and the other one, the sell side imbalance was filled up once and then eventually came in and retraced into it. If it wasn't filled, like up here, overlapping above this, then eventually that would have been a balanced price range up here. But it did, eventually this wick right here, it kind of filled it up a little bit and then eventually created a gap. That's not a balanced price range. This is an inversion PD array here. And you can see here again, we tapped and then we dropped. We came back up and we rallied. We didn't create any fair value gaps other than this one right here. We could see eventually, at first this one did get respected, but this one would have been a lot more of a better entry for you. And you could just see that clear as day. We started pushing up and then we created another fair value gap. So just measuring order flow with fair value gaps and highs and lows, this would have been your new external level. And then this one right here too. And you would have your internal level right here. So you can just see that measuring order flow is very ideal with this. And then you created another fair value gap right here. You see price use it as an inversion. And then eventually you had another one right here. It respected it. And then eventually another one was created. And then it became inverse. Once we respected the BISI, once we got there, we rallied up. You can see that clear as day. Left it open as a breakaway gap. We are strong, heavy in that direction. We pushed up to push to where the new external level that was created. We reached that and then we started to just chop around. Beautiful delivery with fair value gaps. An order block is a change in the state of delivery to the highest level, as ICT stated. Not every down close candle or up close candle is an order block. You have to use time as an aspect and the buy and sell programs with the PD arrays to give you narrative for what makes an order block a powerful order block. What I classify as a powerful order block, in order for me to classify an order block powerful, I would need it to be following the institutional order flow, reaching an external high or low, and will create order blocks to justify its delivery. Equilibrium. When at equilibrium, you want price to give you an order block for the justification for reaching to expand higher or lower from equilibrium. So you want to expand away from equilibrium. You could either be higher or lower, but it has to create an order block near equilibrium. The previous day order block, so from a previous session, like if you're trading New York, the previous New York session, you want price to give you an order block from one of those time windows. It could be a higher time frame one to a lower time frame one. Usually for me, it would be to the 15 minute or 5 minute to the hourly chart. A fair value gap. When a fair value gap is overlapping with an order block, it's a unicorn model that makes price move in such a way that is extremely powerful. You can have an order block with the breaker block, same thing, overlapping with the fair value gap, then that would make it very powerful too. As stated, order blocks are internal resistance liquidity. Majority of the time, price comes into an order block to push price to an external level following the institutional order flow. At times, price will leave you and not retrace or come near a level you wanted it to reach, and that should make you happy that your analysis was correct and the delivery was strong. So strong it moved to where you expected it rapidly. For fair value gaps, they are called breakaway gaps, which you will never see price come back into. So here, order blocks can be stated in multiple different categories. A lot of people will classify mitigation blocks as order blocks. I used to be one of them, but here this would be an order block. This is 1, 2, 3, 4, 5 up close candles, the rejection block, then the high. From the PD array matrix is the high, the rejection block, and then the order block, and then below that would be the fair value gap, or as stated, liquidity void, and then eventually the bearish breaker, and then the mitigation block. So that would be your classification. But for here, this is more of a breaker here that you can see it clear as day. And something I used to have a lot of trouble with was higher time frame. Order blocks are lower time frame breakers, but higher time frame order blocks are usually lower time frame breakers. And sometimes you will get mistaken for that, but it is what it is. So here we're going to find 4 down close candles here. You see that we used it as a means to push price higher. We created another one, so that would be here a proportion block, and it dug a little deeper and then it rallied. And then we had a fair value gap there, right here, and it was reaching for the external level of liquidity, and that would be right here from this, and you can see we reached it pretty nicely. If we measure the range here for equilibrium, for the one we had right there, or even for this one right here, see we never came down to equilibrium, which was a good indication, and we left this side of the fair value gap unfilled. To me, that is the part of the breakaway gap. And that's a really good strong delivery, to push price higher in the direction that we needed to reach the external level, and following the institutional sponsorship or the order flow. A little BPR here, came down and retraced back into it too. Again, just nothing but a beautiful delivery here for price, just indicating to us again, order block created with a balanced price range there. You can see price, it dug a little deeper. You could say this one was hit, rallied. You can measure the mean threshold, and eventually it would align with this one, I bet. So you can see it perfectly. This is where the mean threshold is, right here, and it just aligns perfectly there. So you always want to use the measurements or the quadrants to your advantage whenever you're using these PD arrays. Again, that's another thing. It's very powerful whenever you use that. So you want to combine all these factors and use them to your advantage to every single time frame. It doesn't matter. Again, these are just very powerful, and you want to use them to your advantage to measure the order flow. Again, these also can become inversed. So suppose an order block here, these down close candles, you can see got ran through, and eventually they were used. This lower here got ran through, became inverse, and you can see there, used as an inversion. If we scale up on the higher time frame, you'll be able to find a lot more. So let's do that now. So we can see here again, now this right here, it's a higher time frame. Again, here there's a SIBI here. You can see we came and tapped up into it, and then we dropped. So that would have been your trade right there, right here. Again, here SIBI made it inverse, then we rallied. Very strong delivery to the upside, and we were reaching for what? This right here, there. Never came down here. So you can see the order flow was very bullish since we didn't come to the external level there, and we just continued up. We continued up. That was a really strong delivery here. Again, here, this right here would have been, these 2 up close candles would have been your order block. You can see we never respected it. Drop down to the 1 minute. We can you can see price use it as an inversion. We went up, we tapped into it, and we came back down, and we tapped into it, and then we rallied, and we used it with the BISI. So just clean delivery to the upside, and that should have told you enough that the PD arrays were more bullish than bearish. And if there's a bullish PD array and it's being disrespected by bearish order flow, then that means it's going to become inverse, vice versa for the opposing side. If you plan to learn on when to use these concepts, then make sure to watch this video here to know how time is more important than price. And until then, I'll catch you next time.